What's up traders, Tom here with another video. Today we'll be talking about our thoughts on the Federal Reserve intervening in the stock markets again last night, the now risk-on sentiment taking the world by storm, and what looks to be the beginnings of a continued kangaroo stock market for the short term. Stay tuned. So yesterday was a sea of red, now we have a sea of green. The VIX is down, volatility is supposedly lower, and we have incredible moves on the indices. If you were trying to buy the dip at 2800, unfortunately that may now be over as the Federal Reserve have cunningly intervened in the market just as you're about to see significant bearish changes on the charts. The S&P 500 has not been allowed to go bearish now during this whole rally. We'll be talking about the indicators and the ways that they're intervening and when they're intervening and why they're doing it. And specifically, we're also going to be talking about why traders especially need to consider trading other instruments. Remember, indices, if you're investing in them, sure, that's amazing. And buying them, there's no problem with that, especially with the Fed being in the market. But when you are trying to trade, especially if you're trying to trade buying and selling, it's very difficult to do so in a manipulated market. So we'll be taking a look at other options for traders to look at in the future. So just a quick reminder to, of course, subscribe and hit the bell if you've been enjoying our content. Remember, we're giving away $500 to a lucky trader or investor just for being a subscriber on this channel. And if you want to follow us on the socials down below, that would be great too. So what did the Fed actually do last night? Well, they got involved again in the market, this time taking it to a new level. And that's why we're seeing so much more risk on sentiment. For the dip buyers out there, if you didn't get that first level and you were looking just at the 2800, I guess it's a little bit of an unfortunate lesson in why you need to pretty much average into your positions. It's something we'll talk about on this channel, but you can't usually pick the complete lows, especially in a market that's constantly being intervened. I actually had this topic for today's video, and I was going to talk about the Fed intervening on Thursday, but guess what? They intervened faster than even I expected. So it's really unfortunate that they're doing this, but it's because when a bearish signal is about to happen on the S&P 500, they do not want the algorithms in there, and they do not want a change in sentiment or a fear coming into the markets. So what the Federal Reserve have done is, of course, they've got the markets back again. And this time they're telling the markets they want to keep credit spreads under control, and they're going to use their purchasing facility on the secondary market, corporate credit, and they're going to basically now start buying diversified market index US corporate bonds created expressly for the facility. So this is a new one because this twist effectively means that they are now individually buying into the secondary market, and this is a new thing for the Fed to do. Doesn't surprise me they've done this, but it did happen faster than we expected. And it's a signal that they will get into shares as well, in terms of they'll actually start buying pure equities by the time this is all over. You can almost bet they're going to do that because guess what? The Japanese central bank did it as well. So what's happened now is effectively the central banks have put a floor under all of the stock markets around the world. The European equity markets have a floor in them. The US equity markets have a floor in them. And it's going to be very, very difficult to fight these floors because, as I've said on this channel before, the Federal Reserve has a little bit more money than anybody thinks they do. In fact, I've estimated it's upwards of 20 to 30 or even more trillion dollars that they could go to. Will they want to? No. But most people think 10 to 12 trillion is where they'll be at before they fully stabilize these markets and get through this current crisis. So what I want to talk about first is I want to go to the S&P 500, and I want to talk about the importance for all traders out there to make sure that you're seeing confirmation signals before you choose to go short or long. Here is the previous resistance on the S&P 500. And we have the support over here at 3,000, the key psychological zone. But what I want to firstly say is that the market, while in the futures was underneath 3,000, the market quickly opened up above 3,000. And of course, then the Fed intervened and pushed the market higher. Notice what was happening on the moving averages. We had the 20 EMA and the 50 EMA about to cross. Every time this has happened on the stock market since the first time in the 1st of April, we have seen the Federal Reserve intervene very quickly at that point. In fact, I've got a timeline up here. So if we take the first date, which is the bull run that started from around the 6th of April, and we go back and we have a look at what they made in terms of announcement, that was the first time that they announced literally their 3 new emergency lending facilities designed to implement the CARES Act. The next time they had the cross about to happen, they intervened again and they got into the market and basically said, yes, everything's okay, we've got this, we've got your back, everything like that. So they clearly are scared of the algorithms or a sell signal that's strong to come into this market. Again, 2050, and now we've seen them go into the corporate bond market again. So they're making these announcements timed, and the boffins at the Fed certainly know what they're doing. It's very, very difficult, and I want to reiterate that, very difficult to short against this market. If you're a trader, you should be looking at other instruments. Even if you're going to short this market, even when the S&P 500 does give you a signal, which it may give you at some point in the future, you want to probably look at things like the Russell 2000 or other weaker indices that don't have the Federal Reserve technical floor backing in them, because that may help you get better profits. However, if you're an investor, there's nothing better than buying stocks when you know the government and the Fed effectively have your back. So the dip may be in for now. Unfortunately, we didn't reach that 2800 that I know a lot of people did want to see. And that means that the NASDAQ is maybe not going to reach that 38.2 Fibonacci and back to the 8800 level. Usually it will. Time will tell. We'll see what the signals continue telling us. But it's all about making sure this main stock market, being the S&P 500, is giving you the confirmation signal. And we did not see a close under 3,000 on this market. We only saw it on the futures market. Very, very important. So before we look at the futures and we look at some other potential instruments that you can use or maybe trade as a trader, let's talk about this. And that is that we are now seeing a $1 trillion infrastructure stimulus, which has been mentioned before, but now is bringing forward into the limelight. Do I think they'll get this passed? Yeah, I do. I think they will. And you probably want to be looking at stocks that are going to benefit from this. I'm sure the market will already be pumping a lot of these stocks today. So we'll have to have a look, and maybe I'll look tonight and see if I can find anything for people out there over the next coming days. But this $1 trillion is most likely going to be passed. It's going to be into infrastructure. That is, of course, roads, bridges, telecommunications, and all of that type of thing. And it looks like it's going to, of course, benefit those stocks. And it's a big part of the overall picture that we're seeing, which is the government is effectively nationalizing debt. If we talk about what has happened, American capitalism has fundamentally changed over this crisis. We have now socialized credit risk and forever changed the nature of how the economy will function. The private banking system will now have some form of calculus as it makes loans. And that'll be things like a price of the loan will now be based on something like the Fed's appetite to potentially buy it. We now have around a third of the corporate bond market now in some form of leveraged or non-investment grade bonds. But guess what? The Federal Reserve is buying these. So you have to change your style for this. And we've been talking about that for pretty much the last 2 to 3 weeks. We're big proponents of trying to buy the dip. The dip got to the first level. It didn't get to the second level. And that's just because the Fed intervened. Would it have got to 2,800 in a normal trading environment? Yeah, it would. It would have got there. That's the kind of thing that will happen time and time again. So if you're going to be able to predict those types of things and you don't have a Federal Reserve getting involved, then maybe that is the better thing to do. So let's take a look at the stock market right now, and it's even moved since shooting this video. It's up to around 31.54. We are certainly going to go and test those highs. But if you're looking at like the no FOMO squad kind of thing, is there still potentially a dip that could happen? There certainly is. We have this is the 2-hour chart, and we have all of the moving averages sitting at around that 30.80. So if we see the market come open and then some form of selling, expect pretty strong buying support around this 30.80 And that's because we'll have all of the moving averages, the 20, the 50, and the 200 on this time frame, acting as dynamic support. And this would be a level where you would see usually a bounce, and the market will probably return to the highs over the next couple of days, and that will be the next form of resistance. So it's happened. There was some MACD divergence, of course, from the lows in terms of the futures. But again, I'll say this, look at the S&P 500 during market opens when the real volume's there. That's where the confirmations are going to be. So we'll see the open soon and we'll see exactly what does happen. But this level is looking relatively strong in terms of the previous resistance will become support, and it was even resistance over here as well. So 3080, definitely a key zone to potentially check out during the market today. So for a lot of the bears out there that may feel like they've missed the dip again and they're wanting to get some kind of opportunity into the market, or even for bulls that are looking for opportunity, gold is always a decent trading instrument and you can definitely get into some good positions. At the moment, gold is also very technical, so that's been very good in the markets. We'll cover that and we'll cover some other Forex currencies and other things on this channel just to show the different trading opportunities versus the investing opportunities in the stock market. Here we have the price trapped between around 1675 lows and around that 1750 in terms of highs. Now the importance of confirmation here is going to be that notice this is the daily chart. Because this is the daily chart, we would need a daily close either above this resistance or below this resistance. And gold is certainly in a channel right now between these zones. So if gold gets out, guess what you do? You're basically looking at the distance of this channel happening again to the high side. And you'll notice that that actually hits previous resistance in terms of where gold has gone before. This is the kind of thing that you're looking for, and this is a real technical setup, and it's the type of thing that you want to trade over time. It's a very nice channel. We'll see what gold does over the next coming days. We'll follow it on this channel, but this is a very nice technical setup with a strong resist at a great 50 zone, which is a psychological zone. And it's all about that close and that confirmation, and then you get in. So of course we spoke about Chesapeake Energy the other day. It looks like now it's filing for bankruptcy. I just want to bring this up because it shows you that there's so many retail traders getting in. This particular stock went crazy. It went all the way up to I think about $88 from $12 or something, and then all the way back down. But you don't want to ever get involved in that type of stuff. Buy quality companies at the best price that you can. And think about this is if you're investing in this stock market, yes, you might make some money quickly, but really you're going to be needing to hold for the longer term. Can you believe in the country over time? Yes, you can, because the Federal Reserve can hold a pretty significant amount of debt for quite a long period. Hopefully everybody's got some stocks in the dip. That dip wasn't long lasting, but it's the type of thing that we're going to see. We're going to see incredible volatility come into the market. And just when you're about to see a bearish signal, I would expect the Fed to get in because they've done it before and they're probably going to do it again. Happy trading, everyone. Remember to subscribe, hit that bell, like the video if you've been enjoying our content, and we'll see you in the next video. Bye.